Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
Today is Thursday, May 14th, 2026. And, right now as we speak, Apple is quietly wiring billions of dollars in cash directly into the bank accounts of its shareholders.
Yeah, it's dividend payout day. Always a good day for investors.
Right. But to understand how any single company can afford to do that without, completely draining its reserves, we're opening up the hood on a quarter that just generated $111.2 billion in revenue.
Which is just a massive number.
It is. That's roughly equivalent to the gross domestic product of a small country. And they generated it in just 90 days. So, welcome to this deep dive. Today we're looking directly at Apple's fiscal 2026 second quarter results.
Specifically the quarter that ended on March 28, right?
Exactly. And on the table today we have their official press release, the condensed consolidated statements of operations, balance sheets, and cash flow statements. Our mission here is to decode the financial DNA of this record-breaking quarter.
And I'm excited to dig in because the sheer scale of that top-line number is impressive. But the underlying mechanics are what tell the real story here.
Yeah, help me read between the spreadsheet lines here, because $111 billion is hard to wrap your head around.
Well, look, we are looking at a 17% year-over-year revenue jump. But what should really immediately grab your attention is the bottom line.
Earnings per share.
Right. We saw a massive 22% leap in diluted earnings per share, or EPS. It landed at $2.01. The financial statements we're reviewing essentially map out, a corporate perfect storm.
A perfect storm of what, exactly?
The highly successful multi-tiered hardware refresh cycle that just perfectly synchronized with their high-margin services ecosystem.
Okay, so let's unpack that. Because to understand the cash flowing out of the company today in the form of dividends, we really have to look at the machinery that brought that cash in over the winter, right?
Yeah, it all starts with the physical products.
Right. Looking at the operations statement, the foundation of this entire quarter rests on a staggering surge in hardware sales.
Yeah.
Total product net sales jumped from roughly $68.7 billion in the same quarter last year
to over $80.2 billion this year.
Over $80 billion. And a huge chunk of that is just the iPhone. If you look at the breakdown by category, iPhone revenue alone hit $56.9 billion. It's a March quarter record.
Yeah, and CEO Tim Cook attributed this directly to what he called extraordinary demand for the iPhone 17 lineup.
But frankly, the mechanics of a 17th iteration breaking records, that requires some scrutiny, doesn't it?
Oh, absolutely.
Usually by the time a product line hits its 17th version, consumer fatigue has long since set in. It's just a given in consumer tech.
Well, the durability of the iPhone product cycle defies traditional consumer electronics models, mostly because it's no longer just a single monolithic upgrade.
What do you mean by that?
So the category numbers reveal a much broader hardware strategy at play. It isn't just the flagship premium iPhone 17 doing all the heavy lifting. Look at the Mac and iPad numbers.
Let me check. Yeah, Mac sales surged to nearly $8.4 billion for the quarter.
Right.
And iPad sales climbed to over $6.9 billion. So they launched the iPhone 17e alongside the M4-powered iPad Air and the new MacBook Neo.
Exactly. And that created a coordinated hardware ecosystem upgrade. Management was leaning really hard into that narrative, too.
They were. In the press release, they were tossing around words like captivating to describe the MacBook Neo launch, which is
pretty unusually poetic for an earnings report.
Right. Very poetic for a spreadsheet. But looking at that $8.4 billion in Mac sales, the hyperbole actually seems justified.
The data supports the rhetoric, yeah. Because Apple is effectively engineering a synchronized upgrade cycle. They leverage the halo effect, not just to acquire new users, but to trigger simultaneous cross-category purchases from existing ones.
Oh, so buying one device naturally leads to buying another.
Precisely. When a consumer buys the iPhone 17 and they experience the latest iteration of Apple's silicon and the software integration, the psychological friction of dealing with an older, slower secondary device increases.
Oh, I've felt that. You get the new phone and suddenly your 4-year-old laptop feels unbearably slow.
Right. Suddenly, the M4-powered iPad Air or that new MacBook Neo becomes a highly logical, immediate upgrade, just to maintain that unified, frictionless workflow.
That makes a lot of sense.
Furthermore, strategically positioning the iPhone 17e provides a crucial foothold in slightly more price-sensitive demographics. It significantly widens the top of the funnel for hardware acquisition.
Okay, so generating $80.2 billion in product sales is an undeniable triumph of supply chain logistics and marketing. But that hardware revenue is ultimately just the setup, isn't it?
That's the foundation, yeah.
Because the true profitability multiplier is the mechanism that turns a great quarter into an historic one that kicks into gear the precise moment those millions of new iPhone 17s and MacBook Neos are unboxed.
Connected to Wi-Fi and logged into an Apple ID.
Exactly. The second those screens light up, they transition from a one-time product sale into a recurring revenue engine.
And we see that transition immediately reflected in the services revenue.
Right, which hit a brand new all-time high of nearly $31 billion for the quarter.
Up significantly from $26.6 billion a year ago.
Now, the $31 billion is huge, but the number that actually made me reread the income statement was the cost of sales.
Oh, the margin difference is staggering.
It is. To generate that $80.2 billion in physical product sales, it cost Apple about $49.1 billion, which makes sense. Building hardware is intensely capital heavy.
Right, you're paying for rare earth metals, silicon fabrication.
Global shipping logistics, massive assembly facilities, all of it. But the services category,
Right.
they generated almost $31 billion in revenue, and the cost of sales was only $7.2 billion.
Those numbers perfectly illustrate the economic beauty of digital scale.
How so? Walk me through that $7.2 billion.
Well, the $7.2 billion cost of sales for services covers massive expenses. We're talking maintaining server farms globally, bandwidth, licensing deals, cloud infrastructure.
Which isn't cheap.
It's not. However, once that underlying digital infrastructure is built and paid for, the marginal cost to deliver Apple Music or iCloud storage or an App Store transaction to the next user.
It drops practically to zero.
Exactly. It's almost pure profit at that point.
It fundamentally changes how you view the company's core business model.
Yeah.
I mean, it's like Apple is a high-end construction firm selling you a state-of-the-art, custom-built luxury house. That's the hardware.
I like that analogy.
Right. But the catch is, they also privately own the water company, the electric grid, and the municipal internet provider you are strictly required to use to actually live in that house.
That's a very accurate way to put it. Tim Cook emphasized in the report that Apple's 6 software platforms, spanning from iOS all the way to visionOS, provides seamless experiences pushing these breakthrough services.
So looking at those astronomical software margins compared to the hardware costs, are we watching Apple quietly transition into a services company that just uses hardware as a loss leader?
Well, a loss leader implies they aren't making money on the hardware, which...
Oh, true.
Yeah, the $31 billion in product gross margin definitely disproves that. It is a deeply symbiotic relationship there. Chief Financial Officer Kevon Parekh actually highlighted this interdependency.
What did he say?
He pointed out that continued strong customer demand helped them achieve a new all-time high for our installed base of active devices.
And a record installed base isn't just a vanity metric. If you understand the demographic of that user base, you realize it is arguably the most valuable aggregation of consumers on the planet.
Without a doubt. We are talking about hundreds of millions of users who mathematically skew toward higher disposable incomes.
And most of whom already have an active, verified credit card permanently stored on file.
Right, protected by biometric security. Face ID or Touch ID makes purchasing entirely frictionless.
So the frictionless nature of that ecosystem is what really drives the margins.
Absolutely. Every single iPhone 17e, every MacBook Neo, every M4 iPad Air sold instantly becomes a permanent, highly secure storefront in a user's pocket or on their desk.
It's a proprietary distribution channel
that competitors cannot access. When that installed base hits an all-time high, services revenue naturally accelerates. High-volume, premium hardware sales fueling hyper-profitable, zero-marginal cost digital services. That's the exact mechanism driving that massive 22% bump in earnings per share.
Okay, so the hardware is essentially the Trojan horse for the high-margin digital utilities. But to achieve a record $111.2 billion quarter, a localized success story isn't enough, is it?
No, it has to be global.
And the macroeconomic environment right now is notoriously hostile. The press release explicitly outlines major risk factors.
Yeah, they mentioned highly competitive and rapidly changing markets.
Volatile global and regional economic conditions, shifting geopolitical tensions, all of it. So this ecosystem strategy has to resonate universally, regardless of local economic turbulence.
Which is incredibly complex. Executing a uniform growth strategy across wildly different geopolitical and economic landscapes is, well, it's really hard.
Because usually one region pulls the others down.
Exactly. Multinational corporations frequently see massive gains in one region entirely wiped out by currency fluctuations or regulatory hurdles in another.
Yet, the regional breakdowns in this report tell a completely different story. Management proudly reported double-digit growth across every single geographic segment.
Which is rare in this economic climate.
The Americas grew to over 45 billion. Europe jumped to over 28 billion. But the metric that's genuinely staggering here is Greater China.
Oh, the China numbers are fascinating.
Right. It saw a massive leap from 16 billion in the same quarter last year to 20.4 billion this year.
Yeah.
I mean, a $4.4 billion jump in a single region in 12 months, especially a region known for fierce domestic tech competition. That's extraordinary.
Capturing that level of growth in Greater China requires far more than just brand momentum. It requires a precise understanding of supply chain localization and consumer behavior.
Right, because they're competing directly with highly capable, lower-priced local alternatives over there. How do they actually execute a $4 billion revenue jump in that specific environment?
The strategic deployment of their diversified product lineup is key here. In markets like China, where local competitors offer compelling hardware at lower price points, Apple utilizes the iPhone 17e as a strategic wedge.
A wedge to get them into the ecosystem.
Yes. It provides a more accessible entry point into the iOS ecosystem for price-sensitive consumers, but without diluting the ultra-premium status of the flagship iPhone 17 Pro models.
And once that wedge is in, the switching costs take over.
Precisely. The lock-in effect of the Apple ecosystem is intensely powerful. Once a consumer in Europe, the Americas, or China integrates their daily communications,
Their payment methods via Apple Pay.
their photo libraries into iCloud, the social and technological friction of switching to a competing operating system becomes a massive deterrent.
So by diversifying their hardware entry points with the 17e and the new iPads, they insulate themselves from regional economic dips.
Right. They're proving they can successfully scale their operations to meet demand across entirely different economic tiers simultaneously.
But, generating $31 billion in high-margin services isn't just a product triumph. It actually creates a massive corporate finance problem.
A good problem to have, but yes, a problem.
The operating cash flow generated just in the March quarter was over $28 billion. When you generate nearly $30 billion in raw cash in 3 months, you physically cannot deploy it all back into daily operations.
You can't.
You can't build factories fast enough or hire enough engineers to spend it efficiently, which forces the board of directors into a corner regarding capital allocation.
That level of liquidity presents a highly scrutinized challenge for the board. Retained earnings that just sit idle on a balance sheet actually drag down the company's overall return on equity.
So the capital must be deployed to generate shareholder value.
Exactly.
So we look at what the board decided to do. As we mentioned at the very beginning of the deep dive, today they are paying out a newly increased cash dividend. The board declared a dividend of 27 cents per share.
Which represents a 4% increase.
All right, so if you hold shares, you get a check today. But that dividend is a relatively small mechanism for moving capital. The true headline grabber in the financial statement is that the board authorized an additional program to repurchase up to $100 billion of the company's common stock.
A $100 billion buyback authorization is a monumental deployment of capital.
It is massive. To put a visual to it, it's less like a dragon hoarding gold and more like a highly successful restaurant buying out its own silent partners.
Oh, that's a good way to look at it.
They are taking the excess cash directly from the register to aggressively buy back ownership stakes, ensuring that the remaining partners get a much bigger slice of all tomorrow's profits.
But that is exactly what a stock buyback does.
But I have to push back hard on this strategy for a second. Yes, they spent $11.4 billion on research and development this quarter, which is a massive R&D budget.
Huge budget, yeah.
But if you have $100 billion in excess cash, why wouldn't you acquire a major player in the artificial intelligence space? Or buy out a cutting-edge automotive tech firm? Why buy your own stock instead of buying the future?
Well, the decision between stock buybacks and massive acquisitions usually comes down to risk assessment and the cost of capital. Acquisitions at that scale, buying a $50 billion or $100 billion company,
Yeah.
they often destroy shareholder value through integration nightmares, clashing corporate cultures, and misaligned product roadmaps. It's incredibly risky.
Oh, so they view buying external companies as inherently riskier than betting on their own established ecosystem.
Absolutely. When a board authorizes a $100 billion share repurchase, they are executing the ultimate signal of corporate confidence. They've analyzed the landscape of available external investments and concluded that the most undervalued, reliable, and fundamentally sound asset they can purchase is, well, their own company.
Walk me through the actual math of how that benefits the listener who might hold a few shares. Like, how does the company buying its own stock help the individual investor?
It comes down to basic supply and demand mathematics. When Apple buys its own stock on the open market, it retires those shares. The total number of shares in existence permanently shrinks.
Okay, so the pie stays the same size, but there are fewer slices.
Exactly. Therefore, even if the company's net income stayed completely flat year over year, the earnings per share would still increase simply because the overall profit pool is being divided by a smaller number of total shares.
That makes perfect sense. It mathematically engineers an increase in the value of the remaining shares because the denominator is shrinking.
Right. And we have already established through the hardware and services data that their net income is not flat. It's growing rapidly.
Oh, so it multiplies.
Yes, the buyback acts as an aggressive accelerant. The underlying business generates more profit, and that larger profit is divided among fewer shares. That compounding effect is the exact financial mechanism that helped drive the remarkable 22% EPS growth we observed this quarter.
And it perfectly complements the dividend increase, too.
It does. The dividend provides immediate liquidity to the shareholder today, while the share repurchase systematically increases the shareholder's percentage ownership of the entire company over time.
Pulling all these complex threads together, what the Q2 2026 statements reveal is basically a masterclass in modern capital compounding.
It really is.
The cycle begins with physical products. The extraordinary consumer demand for the iPhone 17 lineup, strategically bolstered by targeted new entries like the 17, the M4 iPad Air, and the MacBook Neo, it creates this inescapable global gravity well.
A synchronized hardware ecosystem that captures users across multiple economic strata.
Right. And once a consumer is pulled into that gravity well, they join a record-breaking installed base. They begin utilizing Apple Pay, expanding their iCloud storage, subscribing to services.
Which fuels an engine operating on virtually zero marginal cost, generating nearly $31 billion at massive profit margins.
And the operational execution of this strategy across diverse geopolitical environments, from the Americas to Greater China, buffers the company against localized macroeconomic shocks.
Right, and the ultimate output of this highly insulated system is the $28 billion in quarterly operating cash flow.
Providing the massive liquidity required to fund $11.4 billion in R&D while simultaneously dumping $100 billion into stock buybacks and paying out an increased cash dividend today.
It is a relentlessly efficient machine.
It is. And for you listening, whether you're an institutional investor analyzing a dividend yield today, or you're simply someone using a new M4 iPad Air to listen to this deep dive right now, you are an active participant in the mechanics of this balance sheet.
You're part of the installed base driving those margins.
Exactly. But before we wrap up this analysis, I want to leave you with a final thought to mull over regarding the long-term viability of this model.
Because the question of sustainability is always the most critical factor in corporate finance.
Always. CFO Kevon Parekh highlighted the new all-time high for their installed base of active devices, as Apple continues its strategy of releasing compelling secondary and tertiary devices, pushing the MacBook Neo, expanding the wearables lineup, integrating the Vision Pro. Think about the physical reality of your own life.
Yeah, how much can one person actually use?
Right. Think about your pockets, your wrists, your desk, and your home. Is there a fundamental physical limit to how many active devices one human being can meaningfully integrate into their daily routine?
It's a great question.
Because that limit exists. If a single user physically cannot efficiently utilize a phone, a tablet, a laptop, a watch, and a headset, all simultaneously, what happens to this historically unprecedented financial growth engine if the global consumer base ever actually hits that hardware ceiling?
Identifying where that saturation point lies is definitely the defining challenge for their strategic planners over the next decade.
It certainly is. Something to think about the next time you hear that familiar startup chime, and consider adding another screen to your workflow. Thank you for taking this deep dive with us today, exploring the complex mechanics behind the headlines. Keep questioning the underlying data, keep looking under the financial hood, and we will catch you on the next one.